Welcome to Alternative Investing. I'm Andrew Bell. Here's our Friday co-host, David Kaufman, president of Westcourt Capital. Great to see you.
Good morning.
This is the show, of course, where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. On today's show, we're talking about tech venture investing. And later in the show, we're going to talk to a successful Toronto entrepreneur whose trend-spotting website was bought by Rogers Media after just 2 years. Joanna, founder of sweetspot.ca, has some advice for entrepreneurs, and she'll also tell us about her next venture. After that, we'll hear from the man with the money for these tech startups. Mark McQueen, CEO, Wellington Financial, will tell us the 7 deadly sins for raising capital in today's market. But first, we're going to talk about some trends in institutional investing. That's what the institutional investors are doing this year. What sort of changes are you seeing, Dave?
It's interesting to survey not just what's happening institutionally in Canada, but globally, because often what we're going to see in Canada next month, next quarter, next year is what's happening now in Europe and the rest of the world. And the number one thing that we're seeing, especially because we're in an environment now where inflation, I can't predict when it will happen, but most people would agree that it will happen eventually, is a movement into real assets, essentially into commodities at an institutional level and, of course, at the regular investor level. And there's a couple of ways to achieve that. In Canada, because we have such a resource-laden economy, people that have exposure to the TSX, which would be most investors, already have, albeit indirect, plenty of exposure to resources and to commodities. But what happens is that because of the correlation to the broader stock market, that if the markets were to fall, so too one would expect would those equities. And so what you see is a shift. They call it the beta continuum, a shift into beta commodities, which is one way to buy commodities is to go long on commodities, and that can be achieved with ETFs. Even some of the largest institutions can use ETFs for that. And then you see it going from sort of the raw beta exposure to what people refer to as enhanced beta, which is still using things like ETFs, but there's more to it than that. And we've talked about it on recent shows that CTAs can get much more complicated, of course, than just straight long exposure.
What's a CTA?
CTA is a commodity trading advisor, and these are the people that sort of run the trading of commodities across the globe. And what you see is that they can kind of go bespoke and give you exposure to certain commodities, but not others. They can go long and short, and that's what brings you into the alpha area, which is manager expertise, and that's where you hit managed futures. And managed futures are becoming a much larger component of institutional portfolios because they can go long and short, they can use leverage, they can invest in both financial futures and commodity futures, and it allows these institutions to have the exposure that they want without necessarily having to care which direction the market is going in, because they're often known as trend following. And we've talked about it before. Sure. It's somewhat of a complicated concept, but that you see managed futures being big in that space.
And there's the two other themes you're seeing: more avoidance of risk, and then continuing innovation in access routes. Just on commodities, though, and we'll get onto those other two things in a second. Dylan Grice, he's a strategist at Societe Generale. He's got a controversial thesis out there. He says investing in commodities is a mug's game in the long term. And the reason he says is you're betting against human ingenuity. The big story has been that human beings learn to do more and more using less and less. And so that there's going to be a long-term falling demand for commodities. We've heard ad nauseum about China and India and their infrastructure. But he reckons commodities, there's no real wealth there. The only real creation of wealth is human ingenuity.
That's an interesting concept, and we've discussed that actually on a recent show on agriculture, because, of course, agriculture produces commodities, that will technology always keep up to demand, and that if you can produce more with the same acre or hectare, then in the end there's not a real benefit. But I tend to subscribe to the notion that as the world grows and as the middle class grows in countries like China, I do believe in these macro theses that say that demand can only go up for things like food and fuel. And as you see a greater movement, especially in the U.S., as we see with President Obama's reinforcement of the concept of energy conservation and made-at-home energy, that the more you use commodities that would have been used for food to make biofuels, the less food you're going to have for a growing planet. And that alone, I buy as a macro thesis that commodities are likely to increase in value over time. And, of course, it's chicken and egg because inflation goes up largely because commodity prices go up. But it is a good hedge against inflation to be long in commodities in that situation.
Let's have a look at that other thing, taking risk out of equity and fixed income portfolios.
Right. It's interesting that one of the items we touch on this show all the time is the concept of what is a hedge fund. And true hedge funds hedge, which means that you would expect to make a little bit less in a bull market, but lose a lot less in a bear market.
Yeah.
And there's no doubt that institutions have always, but are now more than ever, trying to access equity exposure in a hedged manner, searching the globe for the best hedge fund managers who are able to extract alpha. So in other words, they don't want to just play that beta game and just buy and hope. Buy a basket of equities and hope that they go up. Rather than that, they go into the hedge space. That's hedging equities. But another way to de-risk a portfolio, of course, is to diversify among uncorrelated asset classes. And these are themes that we touch on regularly. So we have managed futures, which we mentioned off the top, agriculture, which is becoming a greater and greater part of the portfolio, not only of institutions, but even of individuals. And real estate, of course, which is a tried but true and is one of the old alternatives that many people have access to. And that can be either in the debt or the equity side, because it can be through things like REITs on the equity side or mortgage funds on the debt side.
Let's just touch on the last thing, these different channels. What does that mean?
Well, the largest institutions have in-house professionals who can study pretty much everything that's out there, whether it be alternatives or equities or fixed income. But you're seeing more and more specialized firms to whom those institutions can outsource research and say, can you please find an infrastructure play for us? Can you please find a mortgage fund play for us? And it's cheaper for them to pay for that advice to a third-party firm than it is to hire yet another set of professionals and make their overhead larger and larger. So it's really the outsourcing to, I wouldn't call it so much a gatekeeper as to an advisor in these new and emerging areas.
We've got to take a break. We're going to be right back. We're going to be talking to Joanna Track. She built a website that spots hot trends, and she sold it to Rogers Media. She's going to tell us about her next website. We're watching Alternative Investing on BNN. We'll be right back. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. And, of course, we're talking today about tech venture investing, David, a pretty volatile area. Here with us, though, is the founder of sweetspot.ca, a trend-spotting website she eventually sold to Rogers Media. Joanna Track, it's great to have you here.
Thank you.
Can you just remind us, what was sweetspot.ca all about?
SweetSpot started as a daily newsletter and originally was just to one market, Toronto, but over time became an online lifestyle guide for women on everything from fashion and beauty to restaurants. We expanded into different verticals. So for moms, we have Sweet Home, which is home decor and entertaining. My Sweet Baby, which was really directed to pregnant women who are pregnant. So really ran the gamut of lifestyle information for women at all different stages.
And you started all of this. You were in New York. You came back. You said, I'm ready to change the world in Canada. This is 2003. So yes. You have two things working against you. The first is that, the shadow of the dot-com crisis was still very much in the rearview mirror. And at the same time, it's hard to believe this, but this is way before we had YouTube and Facebook and Twitter. Yeah. And so you were in a different space. Talk to us about what it was like starting at that moment in time.
Sure. Yeah, I would argue there was way more than two hurdles, but yeah, those are two of the main ones. It's funny because these days when I talk about it, I say to people, there was no Facebook, there was no Twitter. When they ask me, how did you get the word out with so little money? And it was definitely a different world. I think, though, there was the dot-com, late 90s, early 2000. And then I think what happened was it became the smart-com. And what that was in the previous stage, those companies, they got inflated because they were sexy ideas with maybe sexy people at the helms, and investors were throwing money at them and not really analyzing the business model. I think once everybody learned the painful lesson, then the smart-com came along, and people were saying, okay, great, sexy idea, but where's the business model? Where's the revenue streams? And so for entrepreneurs, they actually had to do the due diligence to make sure this was monetizable, and investors were being more careful to look to make sure that the business model attached to the exciting, interesting idea.
And you use the word monetizable, which is different sort of than the real world, where it's important to have something that monetizes early on or else you go broke. It's still valid, is it not, that in the internet space, in e-commerce or wherever it is, if you have a solid model and you have a way to get to where you want to be, you can still be cash flow negative for a period of time if necessary to ramp that up.
Definitely, because especially on the internet, you need eyeballs or something to generate the revenue. So it takes time to generate eyeballs. You're not going to flick the switch and all of a sudden all the millions of traffic is going to come to your website. But you do have to have a credible story of when I have X number of subscribers, viewers, readers, then the revenue will follow.
Can we get into your experience with bringing in partners, bringing in financing? You started off with a partner.
Yes.
And along the way, I won't say a falling out, but there was some friction. So what does that involve?
I guess I would say, fortunately, it happened very early on. It happened probably within 3 months of the business launching. And it was a business partner who was an old and good friend of mine. And we had come together because we felt that we had complementary skills. I have the business background, marketing, advertising. She was working more in the publishing world. So we thought we would divide and conquer. But we both had very different visions of what role we wanted the business to have in our lives, what we were willing to put in.
What do you mean? You mean she was willing to let it take over her life? Or
no,
vice
the
versa?
opposite, actually.
Okay,
I was building this because I wanted to be an entrepreneur and start my own business and make this my full-time profession. She was actually, well, to her credit, very successful in her world. So she was kind of thinking she was going to do this on the side for fun.
Good luck with that. Yeah.
But we were 50-50 partners, so that wasn't going to work for me.
There's got to be the same level of commitment there.
Always. And I think people run into this challenge all the time. They select business partners. They think that they need that skill set to help them be successful. And I always say to people, ask yourself, do you need that person to be your business partner, or can you hire them as a consultant and outsource that skill?
And thereby keeping all the equity for yourself if the idea turns out to bear fruit the way, of course, you plan it to. At the beginning, one thing that is certainly a constant, whether it be online or in real terms, is the fact that everything that anyone ever wants to do in business typically will cost more than you budgeted and take longer than you thought. There must have been some pretty harrowing days there where you were near the bottom of the barrel, but you still believed in both yourself and the idea?
Definitely. I had some very rough times. I always used to say it was the best of times and the worst of times. It was so exciting and enthralling. There was so much happening every day, but it was extremely stressful. I was very careful, though. I wasn't one to spend what I didn't have and try to invest in major technology stuff if I couldn't afford it. But at the same time, I had to dig into my savings. I had to, take some real risks. And there were times when I wasn't sure that, things are going to turn out.
Could you give young entrepreneurs who are watching some advice, and particular maybe in terms of attracting financing? What should they bear in mind?
I think one thing to keep in mind when you're trying to get financing is to be realistic. So you want to show that your business has a lot of potential, but you got to manage your investors' expectations. So don't be promising them the moon if you don't think that you can really do that. And you don't want to be ultra conservative either, but I'm a big believer of, under promise and over deliver. I think that you have to also be realistic in the sense that things always take longer than you think they will take, and they cost more than you think. So whatever it is you think is going to cost you and how long it's going to take, double it.
Tell us about your new deal, Dealuxe.
Dealuxe. So I'm very excited that I'll be launching Dealuxe in 3 weeks, and it is an e-commerce website.
You pronounce it Deluxe.
It's Deluxe, but there's a little play on the spelling.
Sorry,
it's an e-commerce website, again, targeting women, and it's going to be contemporary fashion and accessories that women can now buy online in Canada.
And what's different, though? I mean, there seems to be a lot of online shopping sites.
There are, but most of them are American. And so a lot of women do purchase from U.S. sites right now, and all deal with the same hassles of having to pay duty and extra shipping costs, and it takes longer.
It's a nightmare,
yeah.
I can vouch for the fact that my wife, for one, will be one of the first visitors to your site. She's always bemoaning the fact that she has to go to the U.S. sites to order what she wants, so I think this is a very welcome change.
And just finally, you sold your first site to Rogers Media.
Yes.
What was that like? Was it a long, amazing dance?
Actually, my lawyer always says she was amazed that it was the shortest deal that she ever worked on. It was very impressive from that end. It was, I think, 90 days from when I first started talking to them that we signed the papers. It was really exciting. Obviously, it was very early in my days at Sweet Spot that they came knocking and formed this partnership, which ultimately led to my exit.
Is there any one thing that you wish you hadn't done along this road? There's a few mistakes. We all make mistakes. But
I think hindsight's 20/20, right? Negotiate more money, do all sorts of things. But I don't think I would do things differently.
Oh, we'll be watching closely, and very best of luck with Dealuxe.
Thank you so much.
Thank you.
Joanna Track. Well, we're going to be right back with our friend Mark McQueen. He actually puts money into tech ventures. He's got the 7 deadly sins. You don't want to miss this right after this.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back. We were just talking to a founder of SweetSpot.ca about what it takes to be a successful entrepreneur in the tech space. Now we're going to talk to the other side, the people with the money who actually make it all happening. Mark McQueen, CEO, Wellington Financial, is here. Hi, Mark.
Good morning.
Tell us, what do you do at Wellington Financial? Remind us.
So pension funds give us money for an 8-year life of a fund, the same way a hedge fund or private equity would do, and we put that money into the genes of companies. A bit more mid-stage, $5 million in revenue up to about 100, so later than the guest on before. But we're trying to find companies that have gotten over that, that chasm and really have a chance to grow.
And the pension funds, they're leaving the money with you for 8 years?
That's right. So some very well-known large pension funds would say, here's $25 million, invest that as a pool, and we would have done 41 transactions in the last 4 years, $5 million each deal. Some are 10, some are 2, and we pay them quarterly from the profits we get from the deals.
And what would you, as a pension fund investor, what would I expect as a target IRR?
We would tell you that if your risk-free rate is 260 right now, preferred return would be 6%. Mm-hmm. If we can get you 8 net, you should be really happy with us. And our GAAP financials the last 4 years we just completed last week would be about 10.4.
So you're outperforming?
So far.
So far.
But, knock on wood.
And obviously we had the tech bubble of 2000. What's the landscape like now?
You know what? I think that it's sane now, frankly. MKS, one of our first portfolio companies from 2001, got bought last night for 2.9 times revenue. That's, in the mid-teens EBITDA. That's not crazy. It's a profitable business. So I think things are fine right now. And I mean, if you've got $1 million in revenue for an online business, that probably gets you a 10-time multiple right now. So it's a heady days to be an entrepreneur again. I think things have changed in 2 years in that way.
If we think of the J-curve, where the first part, like most businesses, where you have a cash burn, it sounds like what you're interested in is, I'll skip the part where I get the stock for free, and I'll invest at a time when you're already on the positive.
We don't mind burn. We're here to help, right? We'll fund burn. VCs are our partners, and they join us, and we each fund burn together.
When you say burn, companies that are burning up cash.
Yes, sir. Losing money every month on a net income basis. Exactly. We're happy to fund burn. That's really the tough part of lending. It's easy to lend money to a guy who's got AR and cash on the balance sheet and is profitable. The hard part is what we do, and that's why the banks don't do it, and that's why there's a need for firms like ours.
Look, let's get on to these 7 deadly sins of capital raising. Gotta love these.
Well, after doing this for 10 years, you see 600 deals a year, and you try and do 10 or 15 of those, and you see some fantastic entrepreneurs. You see some folks who sometimes don't think through what they're doing. So the first sin is just this false sense of urgency, right? I got to see it tomorrow. We got to come in tomorrow. I want a picture tomorrow, and then it turns out they need the money in 6 or 9 months, right? Mm-hmm. There's no necessary sense of urgency. The second thing is, someone comes in the next day, you go through the process, you have a great meeting, and then the model's not ready for 3 or 4 weeks, and there's this gap. And obviously, if you see companies every day, it's unfair to the investor to have this lag, and for the guy who's pitching, the person forgot why I loved your deal. It's been 3 or 4 weeks, and now the model comes, or now the customer call list comes.
Come in with the stuff already, basically.
You want to have a fully cooked plan before you come in. The third is not board approved. Don't show investors a financial model that your board hasn't approved. It sounds like either it's a disconnect, or that your board doesn't believe it, or that this is your stretch plan and that you show them the carpetbagging plan. It's just not good karma. Fourthly, the 5-alarm fire. This is when an investment banker or a lawyer phones and says, payroll's running out in 3 weeks, can we come in and see you? This is not a good time to be raising money. No one can close a deal that fast. And frankly, to get through the process to understand why it might be a good idea 1 in 100 in those situations, probably going to be a good use of time, and you can't be bothered.
Now, sometimes, of course, when you've already chosen to invest, then you have to play the role of, of a distressed situation where you get the five-alarm fire to say, save us, because you have a lot at stake in this.
And that's you're saving yourself at that point.
You're saving yourself.
Right.
And then is that a situation where you say, we will save you now, but now we're going to take a more active role in managing the budget and managing the management?
Look, our partners are venture capital funds, some of the world's largest, like Battery and Sequoia and Sigma and what have you, and here in Canada, Albright and firms like that. So we rely on them to do the heavy lifting. And then when we have to get involved, clearly things have gotten off the rails. We're happy to do it. We're happy to coach. That last $2 million is a lot more expensive, in theory, than the first $5 million that went in. But you have to protect your investment on behalf of your investors, for sure.
David, this tickles your fancy. The cell phone conference.
I love this one.
Conference call. What do you mean by that?
Well, you've got 4 people on a conference call, all calling in from the company, the CFO, the CTO, the CEO, a board member, different parts of the continent, different parts of the world, some on cell phones, some on noisy cell phones, from airport lounges without really contributing to the discussion. And it seems disorganized, right? You don't need 4 people to pitch a story. You need 1 or 2. And the other people here to help doesn't give confidence to the investor. Of course, there's a board behind it or a CTO behind it. But for that first pitch, you don't need to sound disorganized.
But being in the tech space, I presume it's okay if they want to use Skype or WebEx or something to have that first meeting. That's cool.
This is not about the format. This is about seeming to be a person of no fixed address, right? Investors want to imagine you at your desk on the phone somewhere working, not at an airport somewhere on your way skiing at Utah.
Now, people often have short memories, and I love number 6, thanks for nothing. Tell us about that.
Well, so you have a meeting, you spend an hour and a half, you have 3 of your team members there, you've now spent 5 hours as a group, you do some work on the business plan, and you phone, you say, okay, what would you like us to do for you? And they say, well, I need $7 million, these terms, send a term sheet, you do your internal circle to make sure you all are okay with doing that deal. And then there's nothing.
Silence.
And the guy or the gal got 3 term sheets from other people, and they decide to choose Andy's and not yours and not mine.
So they've lost interest in you as a source.
And you never hear anything. And, you've now spent a day and of time of your life as a group, and the person doesn't even spend 2 minutes to email back and say, thanks, doing something different.
We're
it's
out
just
of time.
Short-sighted.
You don't like... Very, very quick. You've only got 15 seconds. What's wrong with these ultra-conservative forecasts?
Let's find that out on due diligence. But don't tell somebody they're ultra-conservative. Let's find out how exciting it is.
We'll find out.
Exactly.
Mark, always great talking to you.
Thanks for having me.
Mark McQueen of Wellington Financial. And, of course, we've got David Kaufman of Westcourt Capital. We're out of time on the show. Get your emails into alternativeinvesting@bnm.ca. Have a great weekend, everybody.